Stop what you are doing right now. Close whatever tab you have open. Put down your phone. Because what I am about to tell you in the next few minutes is not financial advice you can come back to later. It is a contingency plan you need to have memorized before the moment ever arrives. I have been managing money for over 40 years. I have navigated Black Monday in 1987. I have been through the dot-com implosion, the 2008 financial collapse, the COVID liquidity freeze. I have sat across the table from central bankers, finance ministers, and heads of state during moments of genuine systemic panic. And in all of that time, across all of those crises, there is one scenario I have watched ordinary people get completely blindsided by every single time. Not the market crash itself, not the bank failure, not the headline. The moment they tried to access their own money and could not. That is the moment where the crisis stops being abstract and becomes personal. That is the moment where a theoretical financial problem becomes a very real problem about whether you can pay your mortgage, buy food, or cover a medical emergency. Today, I am going to walk you through exactly what to do in that moment. Not before it, not after it, in the moment. Because if that day ever comes, the decisions you make in the first 24 to 48 hours will determine whether you come through this relatively intact or whether you lose a significant portion of what you have spent a lifetime building. I want you to picture something very specific. You wake up on a Tuesday morning, normal morning, you make coffee, you check your banking app like you always do, and there is a notice waiting for you. Effective immediately in response to current market conditions and in coordination with federal regulators, our institution is implementing temporary withdrawal limitations. Cash withdrawals at branch locations are limited to $500 per day. ATM access is capped at $200 per transaction per 24-hour period. Outgoing wire transfers are temporarily suspended pending regulatory review. Digital transfers to external accounts are paused while guidance is finalized. Your first instinct is to call the bank. The hold time is 4 hours. Your second instinct is to check the news. Every outlet is running the same story. Major financial institutions across the country have received guidance from the Federal Reserve and the Treasury Department. The measures are described as temporary, precautionary, and in the best interest of long-term depositor protection. Your third instinct is panic, and then the practical reality hits you. Your mortgage auto payment is scheduled for Thursday. Your payroll for your small business runs on Friday. Your daughter's tuition payment is due next week. Your elderly mother's nursing home bill pulls from this same account, and you cannot access any of it. That feeling I just described, that mixture of disbelief, helplessness, and dawning terror, that is exactly what hundreds of thousands of people felt in Cyprus in 2013. That is what Argentines felt in December 2001. That is what depositors at Silicon Valley Bank felt on a Friday morning in March 2023 when they woke up to find that the 16th largest bank in the United States no longer existed. And every single one of them said the same thing. I never thought this could actually happen to me. Let me take you back to Cyprus in March 2013 because I think this is the most instructive case study in modern financial history and also the most forgotten. The Bank of Cyprus and Laiki Bank were the two dominant financial institutions on the island. They were modern European well-regulated banks operating inside the Eurozone, not a backwater economy, not a poorly governed developing nation. A full member of the European Union with institutional oversight from the ECB. Both banks had made the decision to invest heavily in Greek government bonds. When the Greek debt crisis unraveled, those bonds collapsed in value. The banks were suddenly, catastrophically insolvent. The EU and the IMF agreed to a bailout. But the condition attached to that bailout shocked the entire financial world. Depositors with more than 100,000 euros would have a percentage of their savings seized to help fund the recapitalization of the banks. Confiscated, not borrowed, not temporarily frozen, taken. And while those negotiations were happening behind closed doors, before any public announcement was made, the Cypriot government did something that no one in that country believed was possible. They closed the banks for 13 days. ATMs ran out of cash. Wire transfers were blocked. People lined up in the streets to try to withdraw a few €100 from the limited machines that were still functioning. Business owners could not make payroll. Families could not access basic living expenses. For nearly 2 weeks, the financial system of a modern European nation simply stopped working for ordinary citizens. When the banks reopened, withdrawal limits were imposed. People could only access a small amount of their own money per day, and for depositors above the €100,000 threshold, a portion of their savings was simply gone. Now I want you to hold that image in your mind while I bring this much closer to home. March 2023, Silicon Valley Bank, California. SVB was not a small community bank. It held $209 billion in assets and served thousands of technology companies, venture capital firms, and startups. It was the 16th largest bank in the United States. It failed in 48 hours. Here is what happened. SVB had deployed depositor money into long-term government bonds during the era of near-zero interest rates. When the Federal Reserve raised rates at the fastest pace in 40 years, those bonds lost enormous value. SVB was sitting on unrealized losses that threatened its solvency. When word began circulating in the venture capital community through text messages, Twitter posts, private Slack channels, a bank run started, not a slow, gradual withdrawal, a digital stampede. Depositors tried to pull $42 billion in a single day. The bank could not meet those demands. It failed. The FDIC stepped in. Now, the federal government ultimately guaranteed all deposits in that specific case. But here is what I need you to understand. That guarantee came after the failure, after the bank run, after the doors were effectively closed. If you had your operating account at Silicon Valley Bank and you were not plugged into the right venture capital networks, if you did not have a friend texting you on Thursday afternoon, if you were simply a small business owner or a mid-career professional who trusted that your bank was sound, you woke up Friday morning to find out that it was not. And for approximately 48 hours, you could not access your money. You did not know if you would ever get it back. That happened in California in 2023, in the most sophisticated financial market in the world, and the conditions that caused it have not been fixed. In many ways, they have gotten significantly worse. Let me explain something about how modern banking actually works, because most people fundamentally misunderstand this, and that misunderstanding leaves them completely unprepared. When you deposit money in a bank, that money does not sit in a vault with your name on it. The bank takes your deposit and uses it. It makes loans. It buys bonds. It invests in instruments designed to generate a return so that the bank can pay you interest and still profit. Under the fractional reserve system, banks are required to keep only a fraction of deposits on hand at any given time. The rest is deployed. This works perfectly well as long as depositor confidence holds. The moment that confidence breaks, the moment people begin to question whether their money is safe, the system becomes acutely fragile, because if even a modest percentage of depositors try to withdraw at the same time, the bank cannot meet those demands. The money has been lent out. It is not there. That is a bank run. And once a bank run starts, it is almost impossible to stop without extraordinary outside intervention. What has changed in the digital age is terrifying. Bank runs used to develop over days or weeks. People heard rumors. They grew anxious. They went to a branch and stood in line. That physical friction gave regulators time to respond. It gave banks time to access emergency liquidity. It gave confidence a chance to recover. That is not how bank runs work anymore. Today, a bank run develops at the speed of a text message. It happens on X and Reddit and in private Telegram groups. It happens when one influential investor sends a single message to 50 portfolio companies at 2 p.m. on a Thursday. Silicon Valley Bank lost $42 billion in withdrawal requests in one day. The entire run was coordinated through digital channels in a matter of hours. The next bank that fails will probably collapse even faster, and the one after that faster still. We have accelerated the speed of bank runs dramatically. We have not reduced the underlying fragility that makes bank runs possible. That is an extremely dangerous combination. Now, I want to give you the specific warning signs to watch for. These are the signals that will appear before any official announcement. They will be visible for a brief window. Pay close attention. The first warning sign is unusual deposit movement at regional banks. When you start seeing regional bank stocks declining while the broader market holds steady, that is a signal. When you see banks quietly offering dramatically higher CD rates to attract deposits, that is a signal. Money does not move for no reason. Sophisticated depositors move first. By the time you see the headlines, they have already acted. The second warning sign is credit market seizure. Watch the spread between investment-grade bonds and high-yield bonds. When that spread widens dramatically and quickly, it means money is becoming afraid. Afraid money runs to safety. It leaves the institutions that need it most. When corporate bond offerings start getting pulled because there are no buyers, the credit machinery is seizing. The third warning sign is emergency Federal Reserve action. When the Fed creates new emergency lending facilities, when they begin allowing banks to borrow against assets at face value rather than market value, that is a direct acknowledgement that parts of the system are under severe stress. They did exactly this in March 2023 with the Bank Term Funding Program. Most people either did not notice or did not understand what it meant. It meant the Fed was quietly preventing a cascade of SVB-style failures at other institutions. The fourth warning sign is official reassurance. I want you to hear this clearly because it sounds counterintuitive. When the Treasury Secretary holds a press conference to tell you the banking system is sound, that is not reassurance. That is a warning signal. In March 2008, Bear Stearns CEO Alan Schwartz went on television and assured investors his firm's liquidity was fine. The firm collapsed within 72 hours. Officials do not convene press conferences to tell you things are fine when things actually are fine. The fifth and most important warning sign is news of large institutional depositors moving money quietly. When hedge funds, major corporations, and endowments begin shifting significant deposits before it becomes public knowledge, it means the most informed players in the financial system have made a calculation. They always move first. Your job is to be positioned before that moment, not scrambling after it. I want to return to history one more time. Argentina, December 2001. Argentina had pegged its currency, the peso, to the US dollar. The government had accumulated enormous debts. The economy was contracting. Does any of that sound familiar? When it became clear that Argentina could not maintain the peg and might default on its sovereign debt, Argentines began rushing to convert their pesos to dollars and withdraw cash from banks. The government's response was the corralito, the little fence. They restricted bank withdrawals to 250 pesos per week. They banned transfers abroad. They locked people inside the financial system with no exit. And then they devalued the currency by roughly 70%. People who had done everything right, who had saved their entire lives, who had trusted the system, who had their money in the bank exactly where every financial advisor told them it should be, watched the purchasing power of those savings destroyed while they could not touch the accounts those savings were locked inside. The Argentines who came through with their wealth substantially intact were the ones who had already moved before the corralito. They had already converted pesos to dollars. They had already moved assets offshore. They had already acquired real property and physical stores of value. By the time the restrictions hit, they were already positioned on the other side. I am not predicting that America becomes Argentina. That is not my argument. My argument is that the mechanism, the specific series of events through which governments restrict access to private money when financial systems are under acute stress, is universal. It is not unique to developing economies or poorly governed states. It happened in Cyprus. It happened at Silicon Valley Bank. It has happened in various forms in virtually every major financial crisis in modern history. And the conditions in America today are more fragile than at any point I can remember in 4 decades of managing money. Now, Here is exactly what you do if bank withdrawal restrictions are announced. This is the practical step-by-step plan. Memorize it, write it down, because if that moment comes, you will not have time to think clearly. You will need to execute. Step 1. Do not panic. I know that sounds simplistic, but I am completely serious. Panic is the single most destructive force in a financial crisis. It causes people to sell assets at the worst possible prices. It causes people to make irreversible decisions based on incomplete information. It causes people to focus on the wrong problems. The people I have watched navigate financial crises successfully across 4 decades were almost uniformly people who responded with calm, deliberate action rather than emotional reaction. The people who got hurt worst were the ones who panicked. Control your emotions first. Everything else follows from that. Step 2. Immediately assess what you can still access. Do not assume that all of your money is frozen. Restriction announcements are almost never total. They typically impose limits rather than complete lockdowns. Your job in the first hours is to understand precisely what you can and cannot access. Check every account you hold. What are the specific daily withdrawal limits? What transfers are still permitted? What payment methods are still functioning? If you have accounts at multiple institutions, and I will come back to why you should have done this already, determine which accounts are affected and which are not. Credit unions often operate under different regulatory frameworks than commercial banks. Online banks may have different exposure profiles. Some of your access points may still be fully functional. Know what you have before you decide what to do with it. Step 3. Cover your essential 30-day needs first. Before you make any investment decisions, before you think about repositioning your portfolio, before you do anything else, identify and cover your essential needs for the next 30 days. Mortgage or rent, utilities, food, medications, any critical recurring payments. If you have physical cash at home, and I have said in previous videos that you should maintain 3 to 6 months of essential expenses in physical cash outside the banking system, this is the moment that preparation pays off. If you own physical gold or silver, understand that precious metals dealers will typically continue operating during banking disruptions. Physical metals can be converted to cash or exchanged for goods and services in ways that digital assets cannot. Secure your essential needs. Then think about everything else. Step 4. Do not make dramatic, irreversible moves in the first 48 hours. The information environment during the first 48 hours of a financial crisis is toxic. It is full of rumors presented as facts. It is full of people who claim to know the full picture and do not. It is full of predictions about what comes next that will prove to be wrong. In March 2008, people made catastrophic decisions in the first days of the Bear Stearns collapse based on information that was incomplete and wrong. The same happened in September 2008 during the Lehman Brothers weekend. Decisions made under panic with incomplete information almost always make things worse. Wait until you have clarity on what the restrictions actually cover, what the timeline is, what the government's stated resolution plan is. Then make measured, deliberate decisions. The one exception is if you have financial assets, loans, positions, contractual obligations. That will trigger automatic consequences if not addressed within a specific short window. Those need to be managed immediately. Everything else can wait for clarity. Step 5. Protect your credit and contractual obligations. During banking restrictions, automated payments will often fail. Mortgage payments, loan payments, insurance premiums. The institutions receiving those payments will typically acknowledge this reality and provide grace periods. But you need to be proactive. Contact your mortgage servicer. Contact your insurance company. Contact anyone who expects an automated payment from you. Document those conversations. Get written confirmation of any grace period arrangements. Your credit history, your loan covenants, your insurance coverage. These things matter enormously for what comes after the crisis. Protect them. Step 6. Position for recovery, not just survival. This is the step most people in crisis mode forget entirely. They focus so completely on the immediate threat that they fail to position for what comes after. Financial crises create the greatest wealth transfer opportunities in human history. Assets get repriced. Opportunities emerge that are unavailable in normal market conditions. The people who have preserved capital and maintained liquidity during the acute phase of a crisis are the ones who can act on those opportunities. During a banking crisis, certain assets tend to hold or increase their value. Physical commodities, foreign currencies from more stable economies, equity in businesses with strong cash flows and low debt, real assets with intrinsic value. Think about recovery positioning even while you are managing the immediate situation. Your future financial health depends not just on surviving the crisis, but on how you come out of it. Now, let me tell you what to do before that moment ever arrives. Because if you are watching this and the crisis has not happened yet, you have a window to prepare that will not be available once it does. Open accounts at multiple, genuinely different banking institutions, not three branches of the same bank. Different institutions, a national bank, a credit union, an online bank, different regulatory exposures, different balance sheet risk profiles. If one faces restrictions, you are not completely frozen. Understand your FDIC insurance coverage precisely. Coverage is $250,000 per depositor per institution. If you have more than that at any single bank, restructure your accounts now. Joint accounts, retirement accounts, and properly structured trusts all carry separate coverage limits. Do this before a crisis. During a crisis, your ability to restructure is severely limited. Maintain physical cash reserves covering 3 to 6 months of essential living expenses. Store it securely in your possession, not in a safe deposit box, because if the bank restricts access, you cannot get to your safe deposit box either. A home safe is appropriate. This is not extreme. It is the financial equivalent of keeping a generator and emergency water supply. Basic preparedness. Hold physical precious metals, not ETFs, not gold mining stocks. Physical gold and silver in your direct possession. A gold ETF is a financial instrument. In a genuine crisis, financial instruments can be frozen, restricted, or subject to emergency regulations. Physical gold in your hands cannot. 5 to 10% of net worth in physical metals is a reasonable allocation for most people. Diversify your financial plumbing. Do not have your paycheck, your mortgage, your utilities, and your credit cards all running through a single institution. Spread the dependency. Reduce your single points of failure. Reduce leverage. In a liquidity crisis, debt is the accelerant. If you carry significant margin debt or other financial leverage, reduce it now while conditions are still relatively calm. Forced liquidations at the worst possible moment have destroyed more wealth than almost any other single factor in financial history. I know what some of you are thinking. You are thinking this sounds like the kind of catastrophizing that people do when they want to sell you something, or the kind of extreme prepper content that is designed to frighten rather than inform. Let me be direct about why I am making these specific recommendations right now, in 2026, in a way I would not have made them 5 years ago. The total unrealized losses sitting on the balance sheets of American banks from bonds and loans originated during the era of near-zero interest rates that are now worth significantly less are estimated in the hundreds of billions of dollars. These losses are real. They are not marked to market because accounting rules permit banks to classify bonds as held to maturity and avoid recognizing the loss. But the losses exist, and they will eventually be recognized. The federal government carries over $36 trillion in debt. Interest costs on that debt now exceed the entire defense budget. The Federal Reserve is caught between two bad options: keep rates high and risk breaking the banking system, or cut rates and risk reigniting inflation. The political environment makes coordinated crisis response more difficult than at any point in recent memory. And digital bank-run technology means that a major institution can now fail in hours rather than days. That combination of factors is what I have never seen simultaneously in 40 years. That is what makes this moment different from previous cycles. The cost of preparing and being wrong is very low. Some foregone interest, some minor inconvenience. The cost of not preparing and being wrong is potentially catastrophic. That asymmetry alone demands action. I want to close with something personal because I think it matters. I have made a great deal of money in this business. I have also been wrong. I have been early on calls that eventually proved correct but cost me significantly in the meantime. I have had years where my confidence exceeded my accuracy. I say that not to undermine what I have told you today. I say it to be honest with you about the limits of anyone's ability to predict specific timing in financial markets. I cannot tell you with certainty that bank withdrawal restrictions are coming. I cannot tell you when. I cannot guarantee that the conditions I am watching will resolve into a crisis rather than some other outcome. What I can tell you with certainty is this: the fragility is real. The risk is higher than I have seen it in decades, and the single most reliable principle I have operated by across 40 years of managing money is that capital preservation comes before everything else, not because growing wealth is unimportant. Of course it is important, but because you can only grow wealth if you still have capital to grow. The investors I have watched get destroyed over 4 decades were almost never destroyed because they lacked intelligence or market insight. They were destroyed because they underestimated risk and were completely unprepared when that risk arrived. The investors I have watched build lasting generational wealth were almost always people who understood one thing above everything else. Survival is the prerequisite to success. You cannot take advantage of the opportunities that crises create if you did not survive the crisis. I am telling you, the risk is real. I am telling you the time to prepare is now, before the moment of crisis arrives. And I am telling you that if that moment does arrive, the plan I have laid out today is the difference between navigating it with your financial life intact and being among the people who look back and say, I knew the risks were there. I just never thought it would actually happen. Do not be that person. If this gave you something to think about, subscribe to this channel. Every video I put out is based on real pattern recognition built over 4 decades in markets. I do not produce content to entertain. I produce it because the information matters, and most people are not hearing it from anyone else. Leave a comment telling me which step you are taking first. I read them. They help me understand where you are and what information is most useful to you. And share this with one person you care about, someone who has not thought about this, someone who is trusting the system without a plan for the day the system does not work the way they expect. The goal is not to frighten anyone. The goal is to make sure the people who watch this are never the ones who say, I wish I had known sooner.